Hey guys, this is Bob, and I have Phil with me, another Trade Genius podcast. We have some more math to show you that everybody's thinking that it's pivot time, party time, but we're here to tell you to put the party hats away, and we'll show you when you should pull them back out and how much more loss this market can expect to absorb. Stay tuned.
Also, what Bitcoin and gold is going to do.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening. Okay. Hey, Phil. It's nice when we're validated. So, when we get other people doing these back tests, it's just not you and I out there, lone voice in terms of really how this all works.
Mm-hmm.
And we've got a great chart here, and my voice is shot. And if you can go through these charts a little bit with everybody, then I'll kind of wrap up with a Charles Schwab piece of information I think is very important for people to understand.
All right, yeah. So we'll talk about this. Basically, it affects how the yield curve behaves, what we can expect in these markets, and then we're going to go jump into what gold and Bitcoin look like in these situations, because we're getting a lot of questions on the relationships going forward. So what this shows you is that it's how many trading days from the first Fed rate cut to when we see the lows in the market. And so on average, you're looking at about 200 trading days. Okay. So in our experience, we look at the yield curve going inverted, and typically it takes about 100 weeks to go from the yield curve inversion ending back to where we consider it normalized, which would be about 2.3%, and then it'll fluctuate around up there. But it goes hand in hand, and the reason why that is because typically when you get the first Fed rate cut, it's because recession. So recession typically sends the money into bonds, and then the bonds, as they were inverted, normalized because people now are putting money to work in the bond market, driving the yields down and fixing the yield curve inversion. So that's why the yield curves, when they go inverted, it's a lot of fear. And so basically it's a precursor to the recession. So it's a great signal. And why people ignore that and think that it's not coming, I have no idea, but it's as solid as a rock for a signal. So let's go take a look at the yield curve inversion chart, because what that does is shows us visually what we can expect. And for those of you that have been watching us for a while, you've seen this chart before, but basically this is what happened in 2000. This is what happened in 07-ish. And then this is what we're looking at now. So the yield curve here is really, 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 really negative. And so what we want to see now as this goes up is how do things perform. Now, typically as this cranks right back up to that 2.3% zone, that's essentially where we would expect the bear market to end. You're typically going to see, this is just kind of projecting based on what's happened on previous two bear markets. We'll have a little bump. We could have a little bump into May, but then primarily we're going to see this market push on the lows, and then you usually have a final break similar to what's happened in 07, 08, and what happened back in the dot-com crash. And that's where your yield curve goes bonkers. So we've shown you that before, but then the question is, like, what do things like gold and Bitcoin do? Now, gold, we have a track record on. Bitcoin, we don't. But so we're in uncharted territory with Bitcoin. However, we're starting to see gold-like behavior in Bitcoin, a la we're pumping up to, $26,000 while the market's over here struggling. So what we found is that, or when we look back, gold tends to have an inverse correlation to the market. Now there's periods, especially when it starts to really accelerate to the downside, that everything kind of goes risk off, of course. But by and large, if you zoom out, when we're in these shaded areas of yield curve normalization, and that's what we think we're getting here with this big jump in the inversion, that's what we look for. That means that from this point forward, it's going to take about 100 weeks. And it's not great for the stock market, but it's actually not bad for gold and Bitcoin. So let's take a look at what that looks like. So zoom out here. These are the different yield curve inversions periods that we went through, okay? So this is the first one we looked at. This is the .com crash. So the yield curve inversion stopped inverting here. It took about 33 weeks for gold to bottom out, and then gold started to grind up. But notice what happened to the S&P 500. It was inverted, right? Inverse relationship. And that actually started basically a 10-year run for gold. And my prediction is that Bitcoin is going to have a similar run where we don't have a big 80% drawdown on the next cycle. So this cycle is going to be like a lot different than the previous two that were largely retail driven. Not only are we going into the ETF era for Bitcoin, we're going to be coming out of potentially a recession. So it's going to have this long stretch of risk on. And I think it's going to be similar to what gold did from early 2000s into about 2010, 2011. If we zoom out a little bit more and go over to the '08 era, the yield curve actually started to invert back at the tail end of '06, and the market continued to rise in it. So this market's actually in a worse shape because the yield curve's inverting and we're already down into like bear market territory. However, as the yield curve, the inversion stopped and then started to go back up, you'll notice gold immediately just kept going higher, and it sustained that trend all the way up until basically the end of the crisis. So it's pretty interesting that gold kept the bid until we got to the crescendo of the bear market where everything starts to dump, right? And then, but by and large, though, if you look at where it started at the yield curve inversion, and even when it dumped, gold had a much higher low. Okay. So if Bitcoin does something similar, then the move that we're seeing in Bitcoin would tell us that the lows are in. And at some point in the future, we'll have a risk off event and gold, or a Bitcoin and gold in the market's all going to drop. Okay. Whether that's 2020, it's probably 2024, maybe third or fourth quarter, depending. But somewhere in there, we're going to get a drop. So contrary to maybe all the tremors under the hood, what the relationship gold and the market and inverted yield curves tells us is that it's actually quite bullish for gold and probably for Bitcoin, because Bitcoin has been showing us the cards. Remember, this is the first yield curve inversion for Bitcoin, and it's showing us that Bitcoin is starting to behave like what gold's doing. Now, consider like gold, the market cap's like $8 trillion. Bitcoin's, half a trillion or something like that. So the squeeze on Bitcoin could be quite tremendous. So even though it seems like everything's risk off and it's going to be bearish for the second half of this year, Bitcoin might hold its bid here. And from what we're seeing so far, especially off that bounce from 19,000 to 26, that's $7,000 in a short amount of time. We could have a very, very, very bullish Bitcoin season ahead of us going into the year. And then we have a larger dump as this bear market peaks to the downside. And what I mean by that is this over here. So let's say that this plays out, then we're looking at something like mid 2024. So between Q3 and Q4, we have some kind of pullback, and you might see Bitcoin shave off 30 or 40%. But I thought it was very interesting that yield curves are very, very, very bullish for Bitcoin, very bullish for gold. And it's going to be a very interesting cycle as we move forward. So equities, a little more problematic. Stocks and things like that are going to struggle a little more. So anyway, Bob, I thought that was pretty interesting.
Yeah, and guys, so follow Phil on the Bitcoin moves, and I already have in the watch list, watching Bakkt Holdings and Morrow and Riot and some of those. In fact, I bought a little WULF for my daughter because it doesn't matter. She's not going to touch this account anyway for 30, 40 years. So might as well get a head start on some of these miners, because these could be 10x moves, Phil. So pretty exciting. It was nice that you can see that what we hope to happen is validating. Mm-hmm. And I wanted to show you guys something on Charles Schwab put out a statement, and I think it's fair for us to share this with you. We've been focusing a lot on cash on hand and debt to equity and, hold to maturity, unrealized losses. And Charles Schwab's stock went from $72 down to $44. And obviously I'm concerned because I have all of our family's portfolios in Schwab. And so one of our other subscribers, I can't take credit for this, did some homework on some of these banks, because Morgan Stanley also, which owns E-Trade, has been singled out too. But from the Schwab side of things, the CEO, first of all, bought shares, and then he went out and he explained that what you're looking at is only one corner of the room. And you guys can read this. I'll let you read this on your own. I'm not going to I'm not going to play kindergarten with you. But what he's essentially saying is that if you just focus on just the held to maturity, you're missing the entire picture of our portfolio. Our loan book is clean. Our loan to revenue, our loan to assets is low. We have access to capital. We have access to subsidiaries with capital. We have access to parents with capital. And basically saying is that, if somebody tries to take us out, we can literally just pour cash on it. And so I think now we're learning so much here is that, the season of half informations are coming out. And I want to correct this because we jumped on the hold to maturity thing very quickly. And I want to let people know that we have to do a little bit more digging. And he finishes by saying is that if you're going to hold us to this, you better start looking really hard at the bank's loan books because our loan books are clean. And that's really where you're going to find the problem with the banks, not necessarily in these held to maturity accounts. So I thought I wanted to share that with you guys. And I think we're all going to learn a whole lot about bank balance sheets, assets and liabilities over the next 4 to 6 months, whether we want to or not. And it's good for us to be engaged because, your future depends on being with the right bank. And with that, Phil, I'm going to cut this off. We got some really good comments about things to cover in the future. We're going to talk more bonds. I don't know if we'll do a specific podcast on it, but we'll definitely divert and talk about a strategy for trading with the bond market as the Fed does pause and pivot. There is a strategy. It's not difficult, and it doesn't take you to having to have an investment advisor help you with it. It's just some very straightforward things that you could do, in my opinion. And we'll definitely be talking more Bitcoin, crypto miners, and gold and silver miners as we think that those pivots are going to occur. Which, if I understand you correctly, Phil, those things are going to pivot at about 1/3 the way in and run way ahead of the stock market. So,
well, it's either or. In 2000, it took a little while. In 08 or the 06, 07 inversion yield curve normalization, I should say, it was right as soon as it was normalizing, it was already upticking, and it kept upticking. And that's our situation here. Gold is up, Bitcoin is up as the inversion. Because I'm calling the inversion in. Like today, with the yields moving, the low's probably in on the inversion. So we're starting today on that 100-week outlook for 100 weeks of market not going up, going to bottom out, generational buy opportunities for everyone, and we're gonna walk you guys through this and guide you down. But the way that Bitcoin and gold are behaving here is like the 07, 06, 07 started that inversion, and they never really pulled back until much later when we started fully dumping, which, like we said, is probably the crescendo of the bear market is in 2024, and then you will have a larger pullback. So my take on it is that lows are in, and we actually have a very bullish outlook on gold and Bitcoin from here.
Yeah, and thanks for correcting me. And so I'm already scaling in, so you guys may want to think about scaling into some of this stuff. And but we'll spend a little bit more time showing some charts and things of that nature. So hey, hit the like, hit the subscribe, hit the notification bell. Check us out. Give us the comments in the room, and we definitely answer all the comments that people ask us questions on. And unless you're a stupid troll or something like that, we like to get back to you. And just for the record, I shower every day, but shaving is optional for me. So you guys have a great day. We'll talk to you later.
See you guys later.
Trade Union.